In this week's video, we'll cover a stock market signal that's only been flashed 8 times in the last 40 years. We'll be moving very quickly. The video is designed so you can use the pause button on your video player. Here are some relevant questions that we've been asking and answering in recent weeks, and we'll explore these same questions in this week's video. Do we have evidence of a shift in risk appetite? Do we have evidence supporting a bottoming process? Do we have evidence supporting a sustainable low? What are the downside risks, even in the context of a low or bottoming process? And are we positioned properly relative to the answers to these questions? Some favorable evidence was covered back on July 22nd. After similar moves dating back to 2002, good things happened in the stock market. Drawdowns were relatively muted. In the summary slide on July 22nd, we noted there were reasons to keep an open mind about the market trying to make a stand, and there were still things to be concerned about. And while we had seen some improvement, we really didn't have a lot of data in hand back on July 22nd relative to longer-term breadth thrusts. The weight of the evidence continued to shift, covering this bullish topic on July 29th, this bullish signal on July 29th, and these favorable outcomes on July 29th. Similar information back on July 29th from Ned Davis Research. In recent weeks, we've talked about technical analysis and the importance of subtle shifts in the data. Covered numerous shifts. Here's one here on a weekly chart. Hadn't seen anything like this going back to January 1st. We noted that this look here, black turning down from above green and red, told us to keep an open mind about better than expected outcomes. And on July 29th in the bullet points in the summary, we noted we'd seen some evidence of a shift in risk appetite back on June 24th, additional evidence on the 22nd, and additional evidence on July 29th. And that walking forward, there were some things that we would be looking for in a normal evolution. Evidence presented on June 24th, July 22nd, July 29th, and then a mountain of evidence last week on August 5th, including this sentiment study with these favorable outcomes for the S&P 500 and favorable outcomes for the NASDAQ 100 historically. Back on July 22nd, we said we were open to longer-term breadth thrusts. Fast forward to August 5th, we covered 14 of them. Here's the summary table for those signals and the favorable historical performance. And using a balanced approach, we noted that even in the context of these signals historically, it didn't necessarily mean we were out of the woods. We could still experience significant drawdowns in the S&P 500 after the date of the signal. But for the most part, the average drawdown was less than 5%. The median drawdown was less than 4%. Simply telling us to keep an open mind about better than expected outcomes walking forward. Now let's shift gears to the new studies or updated studies that we'll be covering as of this week. Very, very similar to everything we covered last week. Extremely rare to move from the red line in an extreme oversold condition up to the upper blue line. This is a form of a thrust. It only happened 8 previous times, dating all the way back to 1983. You can see after the previous signals in the past, the S&P 500 was higher in every case 6 months later, 9 months later, and 1 year later. The average gain 1 year later, 23%, median gain roughly 20%, and that's from the date of the signal in this case that was August 5th of 2022, meaning these gains hypothetically would be walking forward from August 5th. So the feeling that we've missed an opportunity at this point doesn't align with these studies and these signals we're covering here. Just as we did last week, the 12 studies that follow are very, very similar to this study. And rather than covering the individual tables, we'll summarize the studies at the end of this segment. Again, you can pause your video player if you want to review these charts in more detail. S&P 500 stocks greater than their 50-day exponential moving average. Here's your thrust. This is the look we've been waiting for. Similar situation, S&P Tech Sector Bullish Percent Index going back to 1996. Only 4 previous times back to 2002, NASDAQ greater than their 50-day simple moving average. And logically, we want to see progression. We covered this indicator in the July 22nd video with a chart dated July 21st. The level was roughly 24. Now we're all the way up to roughly 40 on August 11th. Only 4 previous times have we come down to this oversold level and then bounced. NASDAQ greater than their 200-day simple moving average. Another improvement indicator. Back on July 28th, we covered a chart 80. Now we're up to 87. NASDAQ 100 greater than their 50-day simple moving average going back to 2002. Similar situation here, a little bit slower. We're using the 10-day moving average based on the indicator. Here's your thrust look, the rare move. NYSE stocks greater than their 150-day simple moving average, the rare move from A to B. S&P 500 record high percent index. This is the 10-day moving average of a very volatile indicator. Here's your rare move. S&P 500 greater than their 50-day simple moving average. When we covered this indicator last time, we said we had to clear this level here to take out that late 2008 case, early 2009 drawdown. That's why this chart previously was labeled with orange down here for 2008. But we have now exceeded that level here, speaking to probabilities of a very large drawdown being reduced. S&P 500 greater than their 150-day simple moving average using all of the data going back to 2002. In this case, the low is in, but there's a significant retracement before the resumption of the new trend, and volatility is common in some cases after the signal. S&P 500 greater than their 200-day simple moving average. It's rare to go from blue to green. We just did it. Let's summarize the 12 signals that we just covered. First, let's start with the drawdowns. This is very, very fresh. We're assuming if we apply the percentages of the historical drawdowns in the S&P 500 after the date of the signal, and we apply that hypothetically to the S&P 500's intraday level on August 12th of 2022, in roughly 23% of the cases, the drawdown hypothetically would be less than 2%. 44% of the cases, drawdown in the S&P 500 hypothetically less than 3%. Roughly 72% of the 61 cases or signals that were labeled on the previous charts and shown in this small table over here, roughly 72% of those 61 signals, the drawdown was less than 6%. The average of all 61 cases, the average drawdown in the S&P 500 was 5.26%. The median drawdown relatively muted at 3.58%. Worst case scenario, hypothetically, from the intraday level on August 12th was a drawdown of 15.29. Based on the recent closing low in the S&P 500, if we applied these historical drawdowns to the S&P 500's level during the trading session on August 12th, in roughly 94 or 93% of the 61 cases, the drawdown would be above the recent low. So back of the envelope calculations using these studies in isolation, you can make an argument that there's a 94% probability that the low is in. Notice, that's not a 100% probability. Nothing is certain in the markets. There's still roughly, based on these cases, a 6 or 7% probability that the low will be taken out. So this would be our hypothetical risk. What about the reward? In a nutshell, historically outstanding. Walking forward from the date of the historical signals, the average additional gain in the S&P 500. So hypothetically additional from S&P 500 levels late this week, 25.34%. The median gain 22.48. Roughly 98% of those 61 cases, the S&P 500 was higher a year later. 2 years later, knocking on the door of a 40% gain, the median 37.23. All 61 cases, the S&P 500 was higher 2 years later. Simply telling us to keep an open mind about much better than expected outcomes, and telling us to keep an open mind that the low in the S&P 500 may, emphasis on may be in. All of this helps us assess probabilities, the probability of good things happening relative to the probability of bad things happening. The probability of bad things happening is never, ever zero. If you know your market history, you know the S&P 500 had somewhat of a double dip drawdown. 2015 we dropped, then we rallied, and then we made a lower low on the retest in early 2016. So you can mark these charts and say, to reduce the probability of seeing something like this drawdown here, the second drawdown, we'd like to see the indicator take out this level here. We've done that. And we've done that in every single one of these historical cases where there were additional and serious drawdowns. So we call these need to clear levels tied to these historical cases here. Similar situation here. These are need to clear levels. Speaks to the probability that the final low is in. Same concepts here, need to clear levels. We've exceeded the one shown on the screen, and this indicator has moved from 80% on July 28th to 87%, which is exactly what we want to see, continued improvement. And a fair rebuttal here would be, Chris, you're data mining, you're cherry picking the good charts. And there's some truth to that. However, we should keep in mind that we were using the exact same charts and the exact same indicators earlier in the year to say we really don't have a thrust look. Here's a chart that we covered. It was dated July 14th. There's no thrust here. So the good news here was we're way oversold in a rare way that tells us to be open to a bottom in mid-July. The next logical step would be that we want to see a thrust. So we're not looking for answers. We're asking questions back in mid-July. We have this, we don't have this. So we want this indicator here in the present day to look more like this early stage thrust here. Don't have it on July 14th, but you'll see in this week's video, now we do have a lot of thrust-like looks in hand. Need to clear levels taken out, chart dated August 11th. Covered this research from Dean Christians. Here's his Twitter handle. On July 12th, he put this out in a Sentiment Trader report. A surge above 90% would most likely mark the end of the current bear market. This indicator closed at 86 on August 11th. This indicator closed above 90% on August 12th, clearing this threshold on a closing basis. In the past, we've said this signal here was early. There was a huge drawdown. This is early. There was a huge drawdown. We've exceeded both of those levels. A fair question, especially for clients, might be, why do we do all of this? Because in most instances, we've worked very, very hard for our entire lives to accumulate a reasonable amount of assets. And while beating the stock market every week, every month, every quarter, and every year is an absolutely positively reasonable objective, we have to keep in mind beating the stock market or performing in line with the stock market during the 1929-1932 period could have been accomplished by losing 88% of our assets. Between this peak in 1929 and the low in 1932, the Dow Jones Industrial Average lost approximately 89% of its value. And every one of these lines on the screen here represents a hypothetical drawdown from the recent peak based on actual stock market drawdowns. And in many cases, years of gains and years of savings and investing can be wiped out. So beating the stock market is great, but under our approach, it's also important that we're able to sleep at night, and it's also important that we have a high degree of confidence that we will sidestep something like this if and when it occurs in the future. Probably a better term is mitigate the damage. How about our scores? As we noted in a recent video, it's inevitable that these scores have to rise if the market's going to put in a successful bottom. Back on July 8th, we could check less than 1% of the boxes. A little bit of improvement on July 22nd as covered in the weekly video. Made additional progress as of July 29th. We could check more bullish boxes on August 5th, as we would expect during a successful bottoming attempt. And where do we stand today? Better, worse, or about the same? Significantly better at 38.45% on August 12th during the trading day when the S&P was up approximately 36 points. Since we're using a weight of the evidence approach, you can pause your video player here to review this additional evidence. We've successfully cleared this 2010 hurdle and this 2015-2016 hurdle. Same thing can be said here and here using a different indicator. NYSE new highs. You can see the dynamic here as the S&P 500 makes the COVID low. You can make an argument, similar look here. Why is that relevant? Because all of these data points speak to human behavior, the battle between risk aversion and the tolerance to accept risk. And baked into these charts, expectations about future economic outcomes, future market outcomes, expectations about liquidity risk going forward, and potential counterparty risk. It's not just a bunch of lines on the page. All of it speaks to the transition from a net bearish opinion to a net bullish opinion. July 6th, this would be potential support where the teal is. August 11th, you can see we held near the teal levels here. This is subtle but different. A subtle shift in human behavior. This looks different than anything that we've seen going back to the beginning of the year. We've exceeded this need to clear level here from 2008, 2009. Similar situation using this indicator. We used this chart in a past video and said we really don't have anything like this now. S&P 500 bullish percent index on July 14th, 28.2%. A long way from these readings in here between, let's say, 50 and 70. Where do we stand today? August 11th close, 76.6%. Pause your video player here. During Friday's session, August 12th, we cleared this threshold on the same indicator. The answer to our question is different here on July 14th relative to August 11th. It aligns perfectly with this concept here. Pause your video player speaks to accepting additional risk, a shift in human behavior. Secular trend thesis here as of August 12th at 2:24 p.m. For now, firmly intact. Subtle shift here. Looking at all the data going back to 2002, the only time we've been able to move from here to here was after the major low in 2009. Only have data in this case going back to 2010, but the only other time that we've made a move from A to B, right after the COVID low in 2020. Good things tend to happen. Different than anything we've seen this year. We showed this chart in the past, said we hadn't cleared this level yet here. We've cleared it now as of August 12th. This level up here is after the major low in 2009. Notice we have indicators tied to a broad number of indices, including the incredibly broad S&P 1500. Similar move here relative to the move after the low in 2011. This look here, from here to here, after the low, we're very, very close here, so you can make an argument. This helps us keep an open mind about being close to the low. The low in 2011 doesn't come until early October. These concepts up here, we can add the assessment of recession probabilities baked into all the charts. So when we look at credit spreads, all of these bullet points apply, along with the assessment from market participants regarding recession probabilities. Here's where we are in 2022. Here's the spike that we've had. Credit spreads much lower than 2020, 2016, 2011, financial crisis, 2002 here. These are facts in front of us on every chart, no opinions. Talked about this chart many times. You can pause your video player. This is a good look for stock market bulls. This is the S&P 500 here and here. The concepts summarized here relative to the 12 studies and the historical returns here align perfectly with the concepts in this Bloomberg article. And just as it was important here in May, June, and July to see the formation of a subtle shift, we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.